Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's a weekly technical analysis of New York and London coffee markets. I'll start with New York coffee. The bearish looking bow tie formation has been the second biggest, note that, second biggest, strategic event of this market in recent times. This is the bow tie created 3 weeks ago, the short moving average, currently 213.85, the medium moving average, currently 222 even, and the long moving average, currently 226.25, that I suspect triggered the big move down 2 weeks ago. Prices closed then below the 50% Fibonacci line, the August 21 to February 2022 move at 217.45, and one of the lower trend lines, currently 216.80, of the biggest pattern of, or at least I thought it might be one of the lower trend lines of the biggest pattern that's there. And that's of the November 2021 to date lopsided diamond pattern. Now I thought this trend line, which was the April 21 to date uptrend back then, might be the lower uptrend trend line of this lopsided diamond pattern. However, now looking at the reassigned uptrend, currently at 195.80, well, that might also look like a lower uptrend of this big diamond pattern. Additionally, it all might look like a bear channel as well. Boy, it's not easy, that's for sure. Anyway, a more near-term pattern had been the lopsided cat's ears pattern over late May to mid-July. This pattern is a derivation of a double top pattern, though the right ear is significantly lower than the left, and we have what appears to be a third ear as well, but elements of this pattern still do exist. 2 weeks ago, all, and I mean all, targets for the downside for this pattern were reached, and prices satisfyingly turned back up immediately after. The move up was only as far as the first of the two possible lower trend lines before we saw a move lower again last week. I hope you can now see how all this is complicated and interconnected. Anyway, there is just the bow tie formation of the three moving averages. It's not a perfect bow tie, but the moving averages are in the right order, and it's still there. And bow tie formations, there are two expectations. The first is that between 15 to 20 sessions after the crossover, we should see a move in the direction of the bow tie. This will be between next week, the 29th, well, late this week, next week, the 29th of July and the 5th of August. Secondly, that the market will move in the direction of the second bow tie, that is the one after the crossover. Hence, this looks like a bearish crossover of moving averages. It now depends on what happens at the turn of the month. Now, one final thought. Just keep your eye on that November 2014 high at 201.35. Today this seems to have turned the market higher, so just be aware of it. It's maybe more significant than just its number suggests. London coffee. As I keep saying here each week, mainly because it still resonates to this day, it is that the key difference seen here in London compared to the New York contract is how the peak of the market was back in late December 2021 rather than when New York had it, which was early February 2021. This difference has been crucial to the formation of a pattern here in the London contract much earlier compared to the New York contract. We had a November 2021 to February 2022 head and shoulders top. Admittedly, the first shoulder is split, but the action nevertheless stacks up as a legitimate pattern. The neckline, currently at 2100, is super important, as it resonated as recently as 5 weeks ago when the prices moved up to touch it and almost immediately backed off down. Now, going back a bit, the market broke down through the neckline but ended up until recently unable to penetrate the support area underneath that stretched from the 2004 level all the way down to the 1935 area. Since that first attempt lower back in early May, we've seen the market develop not only intraday indecision such as spinning tops, but also intraday indecision with contrary patterns one after another. This indecision overall worked the market lower, such that at the end of June prices reached the key 2004 level and started tackling it and the other supports initially all the way down to the 1968 area, and 2 weeks ago all the way down to the 1914 area. In the process, they reached the primary target for the large pattern that I've been commentating upon now for weeks. is a large rectangle pattern originating from the start of March until the end of June. Now I call it a rectangle, but it's more to be more like a shallow descending wedge pattern. But for now, a rectangle will do. Needless to say, there was some satisfaction seeing the primary target below reached, and then last week the market immediately turned back up higher. However, the rise was limited by old friend, yes, the 2004 level, the top of the previously mentioned congestion area. That is now resistance, and we have seen prices dip again. Yet the dip was limited today by congestion at 1945. That dates from September and October 2017. I suspect that this level may become a very interesting level to watch. That still leaves us with target X1 below the low of this chart in the 1858 area, and that's the secondary target and a harder to reach target for the previously mentioned rectangle pattern. So there you are. You have the immediate market in between 1945 area below and the 2004 area above. It now very much depends if this market has the appetite to try for the harder target X1. I suspect it is still trying to make up its mind. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.